All right, welcome to our latest investment opportunity, Winston Apartments. We are excited to share about this investment and why we like the deal. We have already had a few weeks of investments already through the 506B portion. We've now switched it over to 506C. Of the few weeks that we had the 506B open, we're already about 25% subscribed. And so I expect on the CRI partner side, we will be subscribed with the 506C in the next couple days. We just completed an opportunity 10 minutes away from this property called Stratton Park Apartments, and that oversubscribed in a few days. So I'm really grateful and appreciative of y'all's time. Many of y'all have invested in one or more deals with us, and it just really means a lot. So, want to first start the evening just sharing that this is not a solicitation to purchase securities. The only document or time that a security is being offered is through our private placement memorandum, which is available through our portal. But any investment advice, projections, or anything of that nature, this is our view of the deal. And so, highly recommend definitely asking questions, not only to us, but to your attorneys, financial, tax, and other professional advisors. As we go along in the presentation, there is a QR code at the bottom. Right now, the offering is open to investments. So you can go in and do a soft commitment and then look at the deal. It's one of those opportunities where you can, show your interest and put your place in line in essence as you're looking at the deal, and then we can do follow-up questions and dig in a little further as time allows with your schedule. But that QR code does take you to the portal. So there's a few reasons I really like the deal. One, this property is already outperforming the submarket. This is day one cash flow on a property that is already achieving market rents. This is not a property where we are intending to go in and do a major deep value add or even a heavy value add. There is value add, and we'll share the business plan. But this is a property that has already been taken care of really well by an owner manager who's owned the asset over 15 years. What I like about that is there's less risk for stabilization and pushing business plan because the property is already doing extremely well on expense control and revenue growth. When I also am looking at deals, I'm also trying to find opportunities where we're already day one less than the tax appraised value. And the reason is because it's been really easy for us, and we've done this on several deals over the last couple of years, where we take the purchase sale agreement and we go to the appraisal district, and day one, we're shaving off 60 to 80,000 plus annual real estate tax, and that drives day one the value of the property, but also the cash flow of the asset. So in this case, it's about $750,000 less than the Bexar County appraisal, and we're going to go through those financials later on in the presentation. Another reason why I love this deal, it's being purchased in a highly desirable neighborhood of Walker Ranch Park. When we look at San Antonio, we're really heavily looking at, like, if you imagine a clock, 10 p.m. or 10 a.m. to 2 p.m., sort of that range or that cone of opportunities. And even within that range, we're looking north of the 410 loop. And so it's right uh, in our zone, but also 10 minutes from a property that we just recently purchased. So we're going to have, quite a bit of scale and opportunities to share expenses with the other property, even though we're not underwriting that way, but there's a lot of opportunities to do that. The other thing I love about it's near the airport. A lot of property areas that we look at being near the airport is not desirable. That is not San Antonio. These areas near the airport are extremely desirable. And so it's all about location, location, location. And we feel like the location is really fantastic for the San Antonio market where we're buying. And then the last one is cash flows. I mean, everybody on this call, including myself, wants cash flow. We want tax depreciation. We are getting fixed rate debt at 5.1%. This is a Fannie Mae loan. And if for those that are not familiar with Fannie Mae, They are extremely conservative with their underwriting, and they are hard to get to the table to say yes. So not only are we underwriting the deal, but you also have, Fannie Mae underwriting, looking at the deal and being extremely conservative on their underwriting. And in doing so, it's like harder to get the loan, but we can get incredible interest rate, in this case, 5.1% fixed rate debt. We're going to go through the cash flow and what it looks like later in the presentation. But, really love that with it already being stabilized and doing extremely well in the submarket, that this cash flow is really well for our investors. So as we go into the presentation, I see a lot of non-familiar faces. I see a lot of familiar faces, but not there's a good group of people that may not know why to invest in multifamily. I look at different uh, classes of real estate, and I say 80% of our portfolio is multifamily. 20% is retail and storage, but 80% is the bulk of our portfolio. And the reason is because at the end of the day, everybody needs a place to live. I've been in commercial real estate over 17 years, heavy in office and retail, and I've seen when times are good, but when times are bad, people, middle of the night move their office stuff out, and but they don't do that at their home. They stay at home. And so from a risk resilience, basic human need is shelter. And so that's one big reason why I've stuck with multifamily. The other is it's when you look at office, retail, multifamily, hotels, multifamily has the best risk-adjusted returns among other asset classes. So when we're diversifying in commercial real estate, just think of it like a stock market. Even within those, there's different sectors, and multifamily has always led the pack on risk-adjusted returns. Love that there's cash flow, there's equity appreciation, tax benefits. These are all things that I'm looking for and our investors are looking for when we look at multifamily. So in this given market, when we look at stability during market volatility, I'm not having to worry about what's going on overseas, what's going on social media, what's going on geopolitically. It's very local to the submarket. And when people are seeing these fluctuations with their stocks, et cetera, for us, for me personally, majority, if not all, I mean, there is a small percentage in stocks and other investments, but heavily our wealth is through real estate. And so I don't have the ups and downs, the market volatility because of that. And so that is one big reason why I push and educate on multifamily investing in particular, is because it's stable. It provides that cash flow. People still pay rent on the first. And what we saw during COVID, when people weren't paying rent because of job conditions, the government came into play to help. We didn't see that much in other industries within, business, much less commercial real estate, but we saw that in multifamily. The other thing we're looking for is inflation hedge. So as inflation, and hopefully inflation continues to go on the downward side, but if inflation does creep back up, real estate is a hedge against inflation. We look at local performance, not global panic. Demand grows both during market instability and stability. So these are all these reasons why we invest heavily in multifamily in particular. So just briefly about myself, I'm Wayne Courage III. We've got about $60 million of properties, assets under management that we are the lead sponsor on. Me personally, I've got over 17 years managing and operating commercial real estate. A big chunk of that was while I was working for CBRE. But I started our company in 2019 and went all in full time in 2023 when our assets were large enough where I just couldn't do both. And so myself, and I'll introduce in another slide our team, but we are full time at this. We are not syndicating deals and going back to our day job. It's really an important aspect for us to be full time focused on these assets that we are not only raising capital for, that we're purchasing on behalf of our investors. My background in education is MBA from University of North Carolina. I have a master's in economics from University of Oklahoma. We have a multifamily meetup the fourth Monday of every month. We have this podcast, Untold Stories of Real Estate Investing, and we just recently started another podcast called Building Passive Income. And we've got other Facebook, Texas Multifamily Passive Active Investor Group. I am a former Marine, Eagle Scout, and a member of the Rotary Club of Bryan. We have grown over the last year and a half where we've added team members. Shelby is our chief of staff. Many of you on this call have spoken with Shelby. She has been an incredible resource to our investors and building that hospitality experience and having somebody, not only myself going to myself, but also having somebody who can assist with the investor portal or ask questions on the updates of the property, or if there's tax document questions. She is that go-to and that resource that we have at our company, and has really been setting our company apart from other companies out there. We've also added a senior portfolio manager, which is an asset manager. So as we grow, I found that it's just extremely important that we invest in the company and we bring on people who are as experienced as Will, who is running our asset management for our properties. So with Shelby, myself, and Will, we are the point of these properties that we are acquiring. We just added a property last week called Stratton Park Apartments. So that through that property, we've pushed over 60 million assets under management. But Ivy at the Galleria, Candle Ridge Park Apartments, Majestic Apartments. We've got a 20 by 50 storage. We have two 20 by 50 storages, one in Bryan, one Huntsville, Alabama. We've got a build to rent community, a multifamily development in Bryan, and then also a retail center. And again, we just added 128 units last week with Stratton Park Apartments in San Antonio. So these are the guys that are also with me. It's a team sport. And Raj, Bio, and Ann and I have been on multiple deals together. We know the strengths of each other and when things get tough, because that's our job as general partners to get through ups and downs. We've worked extremely well together on multiple deals and multiple times. So I'm very grateful for them. Their background is incredible when it comes to real estate. Two of them are, doctors, but are heavily invested in real estate, not only as a passive investor, but as an active investor. And Anne is based out of New York with $30 million of assets under management, and someone who, like the others, join every single week on these property management calls to go execute the investment plan. All right, so let's get into the market. So San Antonio is the largest city by population in the state of Texas. It is the seventh in the US from a population standpoint. In 2023, it was the fastest growing city by population, according to the US Census, and is expected to have a population over 3.5 million. This is a city that I was really wanting to buy about 5 years ago, but I couldn't because every time I underwrote a deal, I would always get outbeat by somebody who was willing to pay $1 million more. Well, these properties have come to a point where we are now going in and buying not only distressed properties, but properties that are of good value. This property is the furthest from a distressed value property, which I like. However, like buying into like San Antonio and being in Central Texas and being close to the Austin submarket, there's a lot of growth and a lot of opportunities as well. And I'll share some of the accolades. But San Antonio, when you think of San Antonio, you may not compare it to like Tampa, Charlotte, Dallas, Orlando, Raleigh, Jacksonville, but it is in that group of cities that over the last 10 years, the numbers of population is leaps and bounds more than a lot of these other major markets. So this slide, is from the JLL Research, Oxford Economics. But if you're comparing the employment growth and the population growth, I mean, it is surpassing a lot of cities and in the hunt with these other top cities, which is good because when we're buying multifamily, we want to be in markets that are growing. I like Houston. We buy a lot in Houston. So Houston, San Antonio, that is all in the path of growth, and which is why we buy. So some of the accolades for the city market. So as I mentioned, it's the fastest growing city in Texas in 2023. It's the second biggest city in Texas with a metro size twice the size of Chicago, a larger population than the entire state of New Mexico. It's a diverse economy, not only with the tech, healthcare, the military, the energy, uh, the family amusement, the entertainment. Just a really great place to live for a family. It's home to five-time NBA champion, the San Antonio Spurs, two major amusement parks. In 2023, it added over 36,000 jobs. From a tourism standpoint, over 40 million people visit there annually, including my family. Like we go there quite a bit. And then a massive, massive military. The Air Force boot camp, as an example, is in San Antonio. Multiple bases, and just a lot of diversification within the city. It also has a major global presence with over 580 million exports in 2024. There's been 11 million passengers handled by the San Antonio airport over the last 12 months. Toyota has expanded with a $531 million expansion, adding 400 jobs, multiple consulates, home to six Fortune 500 companies. There's 47 nonstop flights to the US, Mexico, and Canada, and home to 400 plus companies with global operations. So in short, it's a massive growing city. It's expected to see robust growth over the next 5 years, outperforming the national average. Again, San Antonio is in line with Charlotte, Phoenix, Nashville. You see Dallas there, Vegas. So again, it's in the right quadrant for growth over the next 5 years. So let's look at the regional map for Winston Apartments. Again, as I mentioned earlier in the presentation, I like that 10 to 2 quadrant. So this is right up north, just a couple miles from the airport. So there's a lot of restaurants, a lot of times people are like, hey, based on location, 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 like where's the nearest Starbucks? Where's the nearest in Texas, the HEB? All that's within a mile of this location. So there's a lot of restaurants, a lot of high-end stores, et cetera, in the area. They're great proximity to Highway 281 and Wurzbach Parkway. You're 10 minutes from the San Antonio International Airport, 25 minutes to downtown San Antonio, 20 minutes to Six Flags Fiesta Texas. So there's a lot nearby that's easy driving distance. What I like about this slide is it shows the 1 mile from Winston Apartments. And when we look at it, there's over 29,000 employees within 1 mile. People want to live near where they work. There's over 2,800 companies within the 1 mile radius. There's 34% of the population with college degree or higher. There's a strong rental of 49% of occupied households that are renters. And then we also look at the supply and what is the forecast of supply over the next few years. And there's only 350 units of multifamily expected that's coming online this year with no new starts. And so another reason why we're bullish on buying multifamily is that there's just not a lot of permits going out right now to develop. And so there's going to be this supply crunch over the next few years as the demand in these growing cities continues to grow. People are going to need a place to live, and the supply is going to get, taken, and there's not any new supply to catch up. So there will be a housing shortage over the next few years. There already is a housing shortage. It's just going to really get worse because of the permits. The other thing we're looking at is the median income. Can we grow rents and still have renters that have strong enough income? Which is, in this case, the answer is yes. Over $48,000 of median income. We see a 7.4% growth, according to CoStar, between 2024 and 2029. And then the population 1 mile will continue growing as we see in the market. The other thing to look at is the submarket occupancy rate is north of 85%. So this is a 112 unit community. It's mixed between 72 one bedrooms, 16 two bed, and 24 two bed, two baths. This property is in incredible condition. I have not, and I'm not just saying this because we're doing an investment webinar, like I'm happy to show we have video, Facebook video that we can send. This property is clean. It has AstroTurf, river, and there's other photos. The pool, the generator or the boiler room, supply closets, The roofs look incredible. Like this property has been owned like it's been managed by a long-term owner who has treated it like their baby. If you look at these pictures, 78 of the 112 units have these types of cabinets, and they didn't just like do what we normally do and just, if needed, replace the outer cabinet only. Like they went in and replaced the entire cabinets with wood cabinetry, granite countertops, wood floors. A lot of the units have washer dryers. Like these pictures here represent 78 of the units. And so part of our value add, as we'll talk about shortly, is renovating the remaining units to continue boosting income. But already a big chunk of the property already has been renovated. The community offers, it's fully gated, has laundry facilities, has one pool, has several community grill seating areas. There is a workout room, there is a business center, on-site management, and everything is, you know, really how we would want to do it if we were taking over a property. Just an example on this next slide. We typically add a gazebo and grill area into our properties that we buy. This gazebo grill area is fantastic, and that surrounding that is all astroturf. And in San Antonio, water is expensive, and it doesn't rain as much as other parts of Texas. So when we look at the landscaping and how much of a hardscape it is, it's incredible because we are the beneficiaries of buying a property that has already had a lot of this work done. Example, like if I go in and I put a bunch of this money into gazebos and all, it's good for the amenities and it will draw certain people to the community. It may not necessarily push rents as high as I need them to offset the cost. So, but the pool area, the gazebo, as you see in the right picture, all the landscaping is hardscaped. But let's talk about the value add. Like, what are we planning on doing? So we typically push rents 3 to 5%, even in this market. And we do that primarily through rental bumps. So say if a resident has $1,000 rent, we would go out with a $50 rent increase. And then we would negotiate typically to about $35. So in essence, they would have a 3 or 3.5% rental increase. And we wouldn't have to do this without doing much because likely they're already below market. So unless they went to another property and found like an opportunity to move, that's fine. But then they're going to possibly more likely pay a higher rent. Then they have to pay a security deposit. Then they also have to pay moving charges. So there's the cost to move is a lot more expensive than taking on the $30 or $50 a month rental bump. So we've been really successful in that. And so that is low-hanging fruit. We'll continue doing. But we're also, as I mentioned earlier, there's 78 units already renovated. The remaining units are below market, and we can renovate those units, not even to a level that they're currently in, but just do modest upgrades and still get an $80 to $100 rent increase per unit on those. So that's a big part of it. We're also going to be driving other income because this owner, who's been a great owner, has done mostly Excel spreadsheet type financials, which is nothing wrong with it other than like when it comes to like reimbursed utility or ratio utility billings, those billings, typically we see 85% of water being billed back to residents. At this property, only 50%. And so they're not maximizing and optimizing the operations the best way they can. And that's okay, because that's an opportunity for us to go in and professionally manage the property and push income to where we can achieve and still be market. We do that through a company that we have in San Antonio called Implicity Management. They have over 1,700 doors that they manage. As CRI partners, we always hire third-party management companies for our multifamily. And there's several reasons for that. I'm happy to go through one-on-one on it, but really, having 16 properties in Texas and a majority of those units are in San Antonio, we have scale. We have opportunity. If something happens or if someone's sick or anything, vacation, we've got coverage and a lot of leadership through Implicity Management. So they will be pushing the revenue generation, the expense reduction, and property renovations. So other things we're going to be planning on doing from an exterior standpoint is possibly adding a playground. We're going to survey. Right now, they don't allow dogs at the property. They allow cats, but not dogs. Instead of just saying, okay, let's go, we're going to do dogs and just get that income, what we want to do is be mindful of the current residents and do a survey and get feedback from them. Do they want a dog park? Do they want a playground? How do they feel about having dogs, as an example? So those are things that we'll do a survey. But the physical property, and we've bought properties where we had to replace the roofs, replace HVACs, do a resurfacing of the pool. We spend $1 million on renovations that don't drive the revenue line item because people already expect to have a roof that doesn't leak. They expect in Texas not to have, non-working HVAC. They expect to have a working HVAC. So in this case, we're not having to do that. However, we're going to keep reserves in case something happens. But the business plan here is not to spend money just to spend money. It's actually to be really tight with money, have the reserves, and cash flow the asset. So other renovation plans, add washer and dryers. That's not a capital expense. We work with a local washer dryer company where we lease those units and then we upcharge. And so we're able to get that additional revenue without having to spend the capital investments. And then we're going to continue renovating modest upgrades to the 34 of the 112 units. As I mentioned, minor upgrades, vinyl flooring, new carpet paint. The setup is sort of like volleyball too. Like you're setting up the ball and you're waiting for the next owner too to come in and have meat on the bone to do their value add. So with us already having 78 units renovated, we're going to do modest upgrades and allow the opportunity for the next seller to also continue those upgrades of their whole period. Other things we look at is the FEMA flood map. If our property is in or touching a flood map, a flood zone, we walk away. We don't even further look at the deal. So I like to always put this out there that this property is not in a flood zone. From a risk meter crime report, it's middle of the road. We had another property that was the only property that I had seen that was like in the green, which is fantastic. A lot of times they're like in the red or orange or dark red. So I feel very comfortable about the crime report being middle of the road. I mean, with multifamily and housing communities, there's crime. There's crime everywhere. But I am glad, that it's not in a dark red or, the 100 crime index, right? So yellow or orange, I can get comfortable with once we get and the darker reds, we stay away from. So most of the multifamily we see are on the yellow. As I mentioned, our property management, third-party management company who's doing the boots on the ground, operating the day-to-day deal is Implicity Management. It's a woman-owned multifamily property management company based in San Antonio. What I like about them is they remind me a lot of our Houston property management companies that they're boutique, they're small. And so you feel like, you aren't just a number. Like we have weekly calls with them. We're able to communicate directly with the owner and really provide a lot of feedback, both them providing us feedback and vice versa. And as I mentioned, Will on our team runs heavily on that asset management piece. So every week we're in calls with our property management on every single property. And again, we do that with Implicity Management. So here's some rent comparables. What I want us to focus on this one, and there's not very many slides left, and we'll open up to Q&A. But on the rent comparables, the total per square foot is typically what I look at. I don't really look at the $944 or $1,232 because every property will have a different square footage. And so if we, equalize it to a per square foot basis is what I like. What you'll see is this already at the peak of the market. So our business plan isn't to go in and keep pushing the rents. It's to get the existing rents to market, those that are already living as a property. But we're really going to push heavily on other income. And I'll go through that pro forma. But what I want to show here is like $1.57 for Winston. We go into other properties nearby, $1.47 a square foot, $1.41, $1.29, $1.51. And so if we look at the subject property, Winston, it's about $1.57 and the comp's averaging $1.42. And I would say like a few years ago, I would be like, where's the value add? We got to push rents. But having seen what's going on in multifamily these days, like if we can buy a property that already has extremely low collections, has great tenant base, that is, clean property, that we're not having to go change out the tenants, like the risk just gets smaller and smaller. And if we were to just to do a 3% bump on all of our units every year, we would be adding about 700,000 in value just off modest bumps. And so, what I've always preached and, out there, it's like we don't have to do a home run on every deal and make a lot of money. It's like let's do some base hits, have cash flow, get tax depreciation, and then over a 5-year period, we can still 2x our money without having to go through a major business plan where we have to re-tenant. I've gone through those and they're very stressful. So I'm liking that this property already is supporting the peak of the market, and where we can come into play is professionally manage the asset, reduce expenses where necessary, and really focus in on other income, which is what I'll go into next. So if I look at our 5-year pro forma, we underwrite our deal separately from the property management company, and we don't share, unless they watch this webinar, they're not seeing our numbers. And so when we do our initial underwriting, we want to see where our net operating income lands. And then we look at the property management company and we see where they're, so there's a checks and balances. They don't know what we're doing on our underwriting and we don't know what they're projecting. So there's that checks and balances. And then I also mentioned Fannie Mae being the lender. They also have their underwriting. And so you have these three different groups that are, working separately. But for us having the visibility as owners, we're able to like just compare and make sure we're being conservative and making sure we have enough monies, for repairs and maintenance, et cetera. So when we look at annual rent growth, we're looking at about a 3% annual rent growth year over year. And we can do this, as I mentioned, majorly through people that are already living in the property that are not up to market. Other income growth is 1%, so we're being extremely conservative that we feel like we can do more there, but we're going to stay at 1%. And then our operating expense growth is 2%. We in the past have underwritten this more at 1% because every year we're going out to bid. But with inflation, we have doubled that. We've done 2%. But pest control, pool services, landscaping, all that's bid every single year. And we're really tight on operational expenses. If you look on this side here, this is the T12. They're at 99% occupied. We went there last Saturday and only one unit was vacant, and in the process of being leased. So they have not had a lot of vacancy. And so that's why they have zero here. Rent concessions, zero. Bad debt, zero. Again, it's just been a really well maintained property. However, we feel like when we're going to buy a property, we're going to be professionally managing and taking care of the asset. However, we want to be conservative, right? And so we've got a 1% loss gain to lease, 7% vacancy, 1% bad debt, and we do this year over year, and we're not declining it over, reducing it, over the years. Year 5 we do because we're really in sale mode, so we're going to be pushing consent. We will drive occupancy up as high as we can for sale in year 5. So, but years 1 through 4, we keep this all pretty conservative. Where we see where we can grow is other income. So there's not a lot. I mean, looking from net rental income, 1,383,000, we're actually expecting a smaller net rental income, mostly because, we're being conservative, adding vacancy, et cetera. But in our RUBS, which is utility billing, we know we can go and be more aggressive with this, and we can do that through a third-party company that takes it and follows Texas law and how we can bill back water to our residents. Other income, we can really drive this. I think they have, just because they've been there's been a lot of mom and pop owners that are just not sophisticated. I don't believe that is the case for this one, but they definitely focused heavily on keeping heads in beds and not pushing the envelope. And part of that envelope is, other income, whether that's parking, pushing washer and dryer income, maybe adding dogs, doing market application fees, etc. You know, trash, an amenity fee. I mean, there's different things that the market supports, but they have not done. And so these are the two that we can really drive income. But one thing you may notice is like our effective gross income is in line with their prior year. So we're staying conservative year one, and then we've got modest year over year growth for our income. If we look at our expenses, they sort of are what they are. 3% management fee, that's what Implicity would take. G&A, this is how we would manage the asset. They're high in a lot of these expenses, and that's just because they're not professionally managing the asset. It's the wife is the owner's or the manager is the owner's wife. So, we look at like repairs and maintenance. They don't capitalize their expenses. They're putting it all in operations. And so we would capitalize certain items, but this is, what we would typically see for 112 units in our experience. Insurance, we do have this quoted out, and we feel like we'll be about 832 a unit. Real estate taxes, the real estate taxes, when we underwrite, it's 100% of the purchase price times the mill rate. So, we're being conservative here, which, I think is important. And utilities just keeping that flat over year. Other than, the growth in the future years, but keeping year one in line with prior. So if we look at net operating income at 701,000, debt service is only 371,000. So what that leaves us is about 300,000 of net cash flow that's distributable to investors. For those that are looking at like a debt service coverage ratio, typically what you want to see is typically a 1.25, which means for every dollar of debt service, there's about 25 cents left over for other expenses. That's typically the minimum DSCR that, like Fannie Mae or Freddie Mac would approve to do the loan. On this case, we're at 1.89. DSCR, our debt yield is 9.6. Debt constant is 6.5. And our economic occupancy is 71%. So these numbers pretty much staying in line, even though, we're going to push revenue and do everything we can. But even if we just kept it very similar to what is going on now, like we are doing extremely well on the asset from that standpoint. So let's talk about the returns. So this investment class is already filled, but we do offer this every time we do a deal, and it's a 10% preferred return, no upside. It's an equity side. It's not a higher in the stack. But it's for those people that want that, higher cash on cash or that 10% preferred return, but they don't get the upside. And so again, this is limited to 600,000, and this investment class has been filled. So what we have remaining is Class B and Class C returns, which is for Class B, it's $100,000 minimum investment. This is split as an 80-20. 80% going to the limited partner, 20% going to the general partner, with an 8% preferred return. And so if we look on cash for year one, we're anticipating 5.32%. So for a $100,000 investment, we expect year one to be about a $5,000 return. And it grows every year as we're pushing the business plan. Year three, you notice a drop, and that's because principal. So it's interest only with the loan for 2 years, and then the principal kicks in year three. So you see a drop, but then you see an uptick in year four as we continue pushing the business plan. And then in year five, we sell. So when you add up all the cash flow, and again, this is a day one cash flow deal. So first quarter we'll send distributions. Year one, two, three, four, and five will cash flow, and then we sell year five. And so for a $100,000 investment, we anticipate you getting 196,000 in return. So the 100,000 initial investment plus approximately 96,000 in return. So in all, it's about a 15.4% internal rate of return. Average annual return on this is 19.20. And again, an equity multiple of 1.96. So that's Class B. For the Class C, this is a $50,000 investment. It's a 7% preferred return with a 75-25 split. So on this, the average annual return is 17.6. Again, it takes the cash flow from year 1 to 5. And then when we sell year 5, when we take all those, you average about a 17.6 average annual return. Class C investor equity multiple is 1.88, and the Class C investor IRR is 14.54%. Cash on cash is still very strong, 5.32, 5.75. It dips because of paying principal on the loan, and then we come back year 4 and 5. So our projections are based on a 5.6 cap rate. And where we base our cap rate is really through CoStar Analytics, and we pay good money to have access to their data. But it is one of those like crystal ball, like no one knows where cap rates are going to be. So for me as an operator and someone who underwrites, I use the data that's most respected in the commercial real estate market with CoStar and put that cap rate in, right? But who knows where it will be? It could be 4.5%, which drives 21% IR. But if it goes to 6%, we're still at a 12.3% IR. And it's still like, good return over a 5-year period at a 12%. 6.25, 11%. So these are the ranges of, what the internal rate of the return and the equity multiple looks like, depending on different cap rates. So definitely happy to talk through our projections and why how we come up with our data, but always like to show sort of just how other cap rates do affect returns. And so, that is part of the risk of real estate investing. So let's talk about the deal breakdown, sources of funds. So the total loan is 7.2 million. It's about 65% loan to value. So conservative loan, we're not over leveraging. The investor's equity is 5.2, and this is where the use of funds would go into play. So 11,250,000 for the asset, capital expenditures and reserves is 625,000. Of that 625,000, there's about 200,000 that's in for unit interior renovations, and the rest it's not really earmarked anything. It just reserves in case we have something that needs to be replaced or repaired. So having cash and being conservative on spend is important, and so a big chunk of this is our reserves. Acquisition fee is here, loan fees and closing costs, so title costs and other closing expenses are in the loan fees and closing costs. So this is how the sources of funds will be used. A lot of this is also going to be in the private placement memorandum. Price per door is about 100,000. That is about a 6.4 cap rate. So, very good basis for buying, a 1981 asset. And as I mentioned, it's the 30-year fixed rate, 5.1% interest rate, loan to value 65%, interest only is 3 years. And then our loan amount is 7.2 million. So on this one, it shows the schedule. Right now, we just finished our 506B, so now we're in our 506C stage. And so we will be raising capital between now and July 31st because we're going to be closing on August 8th. I know this says Stratton Park up here. This slide was used from the prior. I apologize for that. But Stratton Park, when we did our raise, it filled in 48 hours. Like it went really quick. So even though the funding is through July 31st, it's really probably over the next couple of weeks, if that, for investments. So use this QR code or email me so I can just get you on the list. So as you're looking at the deal, you can say yes or no, but at least put your spot. But we would need funding no later than July 31st. So that's an important date. And then we will tentatively close on August 8th. We're looking to sell in a 5-year hold period, so August 2030 to August 2032. So this is a 506C deal. We finished our 506B portion, so that's closed. But our 506C is for accredited investors only. So now we're able to go out and advertise and share this to the general population of investors. And so what does that mean? So from an accredited investor, It's based on income or net worth. So if you have a individual, if you're not married, but your individual income is north of 200,000, you're considered a accredited investor. If you're married and have income that's over 300,000, you're considered an accredited investor. Or if you have a net worth of $1 million, excluding your primary residence, then you are an accredited investor. And that's defined by the Security Exchange Commission, not by CREI partners. So all we would need, and most of our investors use verifyinvestor.com. If you've already invested in a deal with us over the last 5 years, which a lot of you on the call have, we do not need another accredited investor. All we would do is like Shelby would email you and say, please confirm nothing has changed since this previous letter, and you would just respond back, nothing's changed, if that's the case, and we would put that in the file. So that is all we would need to do for that. So for now, I'd like to, so we have the QR code, and then here's the website, or y'all can email me for more information as well. But I always like to do live Q&A. So if you were to go into the chat box with the Q&A, feel free to ask any questions in there. And we're starting to get questions now. So one of the questions is do you accept self-directed IRAs? So yes, so cash investments, self-directed IRAs, solo 401ks are all acceptable. We use, if you don't have a custodian or someone who would that you have your IRA with, we've been doing a lot of work with Equity Trust. They've been really great to work with. So we got a question is why the current owner is selling. Well, I mentioned it's a husband and wife. They've owned it for over 15 years. They're wanting to move to Minnesota. So the wife is ready to retire, and my understanding is I mean, just looking at the property, he's got a lot of, he works really hard. And, so it'll be interesting to, see what they do after. But my understanding is they're going to be moving to Minnesota. Let me caveat with that too, is like the biggest risk I see in this deal, and I see this and I'm working through it, is when you have a seller like them who've really taken care of the asset, and that is not the case for a lot of properties. A lot of properties need a lot of work. With this property not needing a lot of work, the biggest risk is who do we replace the property manager with? And so I fully trust Implicity Property Management, but even then, we got to find the right boots on the ground person. And so Will and I are going to be very heavily involved with finding somebody who can come in and provide a great atmosphere, culture, but also, make sure that they can, collect rents and all. So I would say, that hasn't been asked in one of these questions, but that is to me the biggest risk. And that's the job of us at CRI Partners to make sure we, partner with Implicity to find that right person. Is there a prepayment fee on the loan in 5 years? So there is not it's a really great question, because with Fannie Mae, you can do a 5, 7, or 10-year loan. And at first, I was going to do a 7-year loan. But the thing with Fannie Mae is they have yield maintenance, and it could eat quite a bit of your returns if you expect to sell year 5 and you still have 2 years left on the loan. So instead of going with the 7-year loan, I decided to go with the 5-year loan. So what that means for us is that year 5, there's no prepayment penalty. But if we sell year 4, then there is, but it's pretty small because there's only 12 months remaining. And so what we will do is we will start marketing and looking to sell this asset at the end of year 4. So we will have a full year of runway to market and find the best value for the sale. That's a really good question. Other question I've received is, how confident are you with real estate taxes? So with real estate taxes, we are very, very confident, because in Texas, like, they can't tax you more than what you purchased the asset for. And so typically, prior years, we were buying properties that were the valuation was higher than the appraised value. And that was normal because it took a while for the appraisal district to catch up. But now that the property values are resetting, we're going in every single deal. This will be our fourth deal that we go to the appraisal district in Harris County, Bear County. They're all the same, where you go and you show the purchase sale agreement. And then in future years, we have a third party tax advisor who's paid only when they provide savings. And that's very normal in Texas. Every year you fight taxes and they're contingent basis on what they've saved. So, um, anyway, so we'll be aggressively fighting our taxes every single year. Another question here is insurance, just rereading this. So insurance budgeted conservatively? It seems low. So yeah, we budgeted over for insurance. It was a 4% increase in San Antonio because it's not in, hurricane area like Houston. Very bullish on Houston. I love Houston, but we do have to be more aggressive on rent or insurance growth because it's near the coast. San Antonio doesn't have that. If there's a hurricane heading to San Antonio, then there's bigger problems, and so we don't see that. So what would be like 12 to 1300 a door in Houston, we can see 800 to 850 a door in San Antonio, and that really helps the cash flow as well. They do get quite a bit of hail, but it seems like everywhere there's hail everywhere. So, but that's really one of the bigger risks in Central Texas, not so much the hurricane. All right. Any other questions? All right. Question is Winston Park not showing up under investment opportunities and cash flow manager? Will it be? Yeah, I will. Thank you for letting me know. I will go after this presentation and drop into the portal because it should be active. We did have it as a 506B offering and then we closed it for the 506C. So I'll go in there and open that up. But the QR code, I did check there. It should be working, at least get you the website. So thank you for letting me know. All right. Well, I am, and Shelby is as well, available for any questions. You can email me directly at wayne@creipartners.com and or text me on my cell 512-710-2500. We'll send out this recording as well. But if there's any questions or anything, just please let me know, and excited to partner with y'all on this one.